The War on Poverty After 40 Years, a Minskyan Assessment by Stephanie Bell and L. Randall Wray. The Strategy of Growth Through Private Investment. As discussed, the Council of Economic Advisors pushed the notion of pump priming to generate growth. In the post-war era, with the exception of defense spending, the preferred instrument for generating fiscal expansion has been some type of tax cut or loophole, that is, the shifting of resources to private consumption and investment. End quote. Minsky, 1971. These Keynesian policies to promote full employment relied on a favorable business environment to stimulate investment spending. Various tax incentives, including accelerated depreciation and investment tax credits, were a common feature of the post-war investment strategy. Policymakers also tried to increase the certainty of capital income through the use of government contracts with guaranteed profits, such as those granted to the defense, transportation, and housing industries. However, Minsky, 1973, argued that there were four problems with the high investment strategy. First, tax incentives to shift income to capital exacerbate inequality between ordinary workers and those who have money to invest. Second, high capital incomes would lead to opulent consumption by the rich and emulative consumption by the less affluent, creating the potential for demand-pull inflation. Third, contracts granted to sophisticated high-tech industries generate demand for skilled, high-wage labor, thereby exacerbating income inequality within the labor force. Finally, by targeting the size and surety of capital income, tax cut programs would increase business confidence and debt financing, and borrowers' margins of safety would decline. Thus, a private investment strategy can lead to a debt-financed investment boom, thereby undermining the stability of the financial system. Footnote 5. For more on this, see Minsky, 1986. Stabilizing an Unstable Economy, New Haven, Yale University Press. End footnote. Minsky, 1963, argued that an expansion led by the private sector would tend to increase private indebtedness and financial fragility as debt service payment commitments rose relative to prospective business revenues. In contrast, an expansion led by public sector spending could actually enhance stability by providing safe assets, government bonds issued as the budget moved to deficit. This analysis is interesting in light of the problems created during the Clinton boom, an expansion led by private sector borrowing, with a federal budget that moved to large surpluses. While it is still too early to predict how things will play out, the over-indebtedness of the private sector is hindering recovery. Further evidence to date indicates that poverty, hunger, and homelessness are rising even as the economy grows, with continued slack in labor markets in an apparently jobless recovery. U.S. Conference of Mayors, 2003. In sum, the post-war era was characterized by a preference for private investment strategies. Even as the war on poverty got underway, the Johnson administration demonstrated its preference for private sector spending strategies, passing tax cuts in 1964 and again in 1965 and 1966. By encouraging private sector spending, especially investment, policymakers aimed to stimulate growth in total income. Both these strategies did little to improve the conditions of lower middle-income workers, for example, factory workers, whose real incomes declined by 2.5% over the period 1965 to 70, Minsky, 1971. Worse, the private investment strategies tended to exacerbate income inequality, generate inflation, and undermine financial stability.